Gold and silver were coming off of all-time highs, and it was sort of time for them to take a rest and do a retracement. They had just been time for them to take a rest and a pullback, but I see a very bright future coming up. It's going to be something we've never seen before, just like the response to COVID was something we had never seen before, just like the response to the global financial crisis of 2008 was something we have never seen before. So get prepared. That's my message.
Gold has experienced a significant rally over the past year, driven by increased central bank purchases, rising geopolitical tensions, and declining interest rates. Analysts, including those at Goldman Sachs, have projected that gold could reach $3,000 per troy ounce by the end of 2025, as these factors continue to support demand for the precious metal. However, recent concerns over President Trump's proposed tariffs and immigration policies have led to a reversal in the market. Gold prices dropped for 5 consecutive sessions, reflecting expectations for a more restrictive U.S. monetary policy and a reduction in geopolitical risk, which pushed the metal's value down to its lowest level in over 2 months. This recent decline follows a period of strong momentum for gold, which reached record highs just weeks earlier. Mike Maloney, a well-known market analyst, was not surprised by the pullback, attributing it to the typical slingshot effect seen during periods of rapid price movement. While such sharp price surges are unsustainable in the long term, Maloney remains optimistic about the future of gold and silver. He believes that the underlying economic factors, such as persistent inflationary pressures and heightened uncertainty in financial markets, will continue to drive demand for precious metals, leading to a price rebound shortly. Mike emphasizes the significant role of the Federal Reserve's monetary policies in exacerbating inflation and distorting the broader economy. By maintaining low interest rates and expanding the money supply, the Fed has contributed to the inflation of asset bubbles, particularly within the stock and real estate sectors. As these bubbles inevitably burst, Maloney believes that gold and silver will become increasingly attractive as safe haven assets. Maloney predicts that the ongoing manipulation of monetary policy will only amplify the cycle of economic booms and busts, creating more severe fluctuations in the financial markets. This volatility, he argues, will drive continued demand for precious metals, which are viewed as reliable stores of value during times of crisis. We present the clips of Mike Maloney's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
One of the things that I want to mention is that gold and silver were coming off of all-time highs, and it was sort of time for them to take a rest and do a retracement. They had just been, I had talked quite a while ago about the pan and handle or cup and handle that had developed, and in the handle there was a inverse head and shoulders pattern, a triple top that we were about to violate, and I said there would be a slingshot move, and that's exactly what we got, a slingshot move. But slingshot moves can't go on forever. So it was time for them to take a rest and a pullback, but I see a very bright future coming up for gold and silver, and we'll talk about that later. I do believe that there is something else around the corner, and the longer it takes to happen, the worse it will be, because the greater the warping of the economy and the pressures that are building up. And so the Fed's playbook is drop interest rates to zero, create a whole bunch of currency. The currency then creates inflation, and because the rates are being artificially held too low to try and pump the economy back into bubbles, because that's what they've done for this entire century. All of those negative rates are an attempt. Bubbles, it started with the NASDAQ crashing in the year 2000. And they do this negative real rate causes bubbles to inflate, and then the bubbles pop. And so they double down on the negative real rates. I mean, you can see that after 2010, the residual from what was happening with the global financial crisis, pumping to get the world economy going again, caused that first big, and then with COVID, the negative real rates there are just insane. And so we know the Fed's playbook. They've been doing it now for more than 20 years. And as soon as a bubble starts to pop, they're going to try to reflate that bubble. And it just keeps the economy warped and causes these booms and crashes to become much worse and more distorted. The booms have been limited to the places where currency creation goes to first. They create a boom in the stock market or a boom in real estate. With low interest rates, it's a boom in real estate. With currency creation, it's a boom in the stock market. It's wherever that currency goes first. If the banks are loaning the currency into existence, that's usually for real estate and for margin loans. If it's the Federal Reserve creating currency through QE, that's just going directly into the stock markets. And so we know the playbook. If anything happens in the economy, this thing will turn red again. So that's my analysis. So it's going to look very much like the 70s, where it's red, gray, red, gray, red, gray, but mostly red. But even more so than the 70s, like it already does look. And until they get things really under control, and they're out of control, this will persist, meaning the bull market in precious metals will persist.
Federal Reserve Chair Jerome Powell recently indicated that the central bank will continue to cut interest rates cautiously over the coming months, as inflation remains persistent and has yet to reach the Fed's 2% target. Economists predict another quarter-point rate cut in December, following previous reductions in September and last week. Despite inflation easing over the past 2 years, Mike Maloney argues that the Fed's ongoing rate cuts and the increasing money supply, particularly the M2 money supply, will likely trigger a rebound in inflation. Historically, increases in the money supply show up in inflation data with an 18-month lag, suggesting that the Consumer Price Index, CPI, could begin to rise again soon. With negative real interest rates in place, Maloney expects the bull market in gold and silver to continue as inflationary pressures mount, driving demand for these safe haven assets. Maloney believes that the economic distortions caused by the Federal Reserve's response to repeated crises, including low interest rates and currency expansion, will persist and exacerbate the boom and bust cycles in the economy. He emphasizes that these trends are driven by larger systemic forces, not dependent on political administrations. The Fed's policies have inflated asset bubbles and distorted markets, creating a volatile economic environment. As a result, Maloney predicts that gold and silver will continue to be attractive investment options for those seeking protection against inflation and economic instability, as traditional assets face increasing risks.
Being something in the economy that we are not. Also, I do want to say that people think that the stock market rising was solely due to the election results, but it's the election results plus this little boosting, this tweaking that they gave it. And yes, this last rate cut sort of just like slipped in under the rug. Nobody really noticed it. And so, except the stock markets. I'm going to modify Milton Friedman's famous quote then. Inflation is always and everywhere a monetary phenomenon with an 18-month lag. The monetary aspect came 18 months before we see the inflation. Most of this century, the bubble century, I call it, has been an emergency. It's one emergency after another emergency after another emergency. And that's what caused all that red for this century, is the Federal Reserve's reaction to one emergency after another. And I do believe that that is going to continue. I believe that the things that Ben Bernanke set in motion with QE and interest rates and the way, because the way that the Federal Reserve manipulates the economy is very different prior to 2008 and after 2008. Everything changed once Ben Bernanke. So I believe Bernankenomics is storing more energy to cause an even greater crash than was stored before 2008 with the warping, the real estate bubble that we had and mortgage-backed securities and everything else. We've got a lot that is wrong with the economy right now. And it's interesting, every time something breaks, all of these people that caused the warping say, the free market isn't working, we've got to do something. And they manipulate it and they set us up for the next big crash. And they have done that. The reaction to COVID, you talked about currency creation. Well, each time they sort of have to double down on it. Look at Powell did as much in the response to COVID as Ben Bernanke did over a period of years in QE1, QE2, and QE3. It was the same amount of the scale of currency creation compressed into just a few months. And so with the deficits that we're currently running, the size of the national debt, everything else, this is going to, the next great inflation of base currency is going to be on a scale that matches the size of the national debt and everything. So it's going to be something we've never seen before, just like the response to COVID was something we had never seen before, just like the response to the global financial crisis of 2008 was something we have never seen before. So get prepared.
With the Federal Reserve preparing to signal a gradual path of easing, coupled with emerging inflation risks, gold is expected to maintain its bullish momentum in the near term. Analysts are forecasting that a rate cut and a slowing labor market will likely provide additional support for gold, with some predicting prices will reach $2,900 by the end of this year. Gold could see continued upward movement as inflationary risks persist and the Fed remains accommodative. With negative real interest rates and a growing sense of economic uncertainty, the demand for safe haven assets like gold will likely strengthen. If these trends persist, many expect gold to achieve new highs in the coming months, driven by policy decisions and broader economic factors. Please share your thoughts on Maloney's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.